Oh, you have those things.
And then we're just raking money.
Rent these heads out.
China is a great example of indefinite pessimism.
Cost center, and he's made it into a profit center.
It's fucking mind-blowing.
Hey guys, welcome to another podcast at 3Com. Today we're going to talk about the Silicon Valley Bank, what all is going on, and what are the implications in India and the world. This is like an emergency podcast, you could say, because shit is really going down. Okay, we have a guest speaker here, Anish Dutta.
Hello, what's up,
Okay,
guys? Yeah,
take it. The
thank
floor
you,
is
thank
yours.
you,
Tell us what's
Yash.
happening.
Glad to be on the Three Comma podcast. Welcome back to episode 11, guys. So today we're going to be talking about how a 40-year-old run ended in just 48 hours. I know that sounds intense, and this is actually the second biggest bank collapse in the history of the world, right after the 2008 meltdown. So, this could mark the start of the recession properly. And we're here to break it down for you guys, nice and simple, talk about the emotions and what it could mean for the Indian startup environment. So yeah, let's start right off. Let's get right into it. Basically, the Silicon Valley Bank has been a major player in the American startup space. It has its hands in about almost 50% of all startups in America and about 44% of American tech. Basically, it's been handling their money. Okay. So, with such large deposits of about 175 billion, you might wonder, like, what does it do? Right? How does it like increase its money, or how does it like make more money from there? What they basically did was they invested in mortgage-based securities. Okay, and that essentially is a bond, right? And for those of you guys that don't know, the bond prices are inversely proportional to interest rates. So if your interest rates go up, essentially your bond prices are going to go down. And a bond has a lock-in period of about 10 years usually.
Okay.
So,
Can you break that down a little bit more? Like, so why does that correlation exist? Why
so
are they inversely proportional?
okay, so basically, okay. How do I simplify this? Okay, so think of a bond like a contract. Okay, so the contract states that for 10 years, I'm going to be locking in this money with you. Okay, and you are free to make that use that money and make that money for your however you want, and you have to return me a certain percentage. Okay, so like I'm the bank, I'm giving you some money. We have signed a contract, which is the bond. You are free to use that money, and you have to return me a certain percentage. But inside that contract, there is a specific clause which relates the percentage that is being returned with the interest rates. Because you, the person who is using that money, um, the amount that you can make back is directly proportional to the interest rates. So if you do not factor in that interest rate into the contract, then it becomes kind of unfair to you.
Okay.
Okay. So what happened was recently, because of the crash and everything, the interest rates were very, very low, almost near 0%.
Hmm.
Okay. So a lot of people took advantage of this
0.1 to 2.
and went ahead and signed, locked in their bond contracts, and they took all that money. They started taking money. They started taking this. They started taking money, and SVB is going to profit from that. But what happened was the Fed started raising those interest rates again so that they can take more money. They can the Feds also need to make money and like use that money for their investments, for their defenses, for national development, all that stuff.
Mhm.
So the interest rates started rising very rapidly from 0% to 5%. That meant that who was taking the hit now? The bond issuer, which is Silicon Valley Bank. Basically, because of this raise in interest rates, their bond returns were being affected. Like I said, it's inversely proportional. So that started depleting a lot. And one more thing, so that's also okay because they can issue more bonds, raise more money. Where the real killer thing happened was that Once these startups are going through a sort of cold period where angels were not really giving out investments that well. Like they're not there's IPOs were not doing that well. Every single IPO, if you saw in India, was tanking.
Yeah.
That was the same thing that was happening in America, and money wasn't flowing as nicely as it was before, right after the Corona return. Okay, and because of that,
Mm.
to pay the startups had to still pay their employees though, but they weren't able to. So what would they do? They would have to withdraw their deposits from the SVB bank, so from Silicon Valley Bank.
Mhm.
And so a large number of people started to like withdraw their deposits from the from Silicon Valley Bank, but SVB didn't have enough funds to cover that. So they start panicking.
Mhm.
Their funds are locked in a bond for 10 years. They're making losses in that bond. And on top of that, the guys who gave him that money are trying to take that money back. So, what option do you have?
Yeah.
You have no other options other than to sell your bonds at a loss. Okay. So, they had about, let me just check the stats. They had about billions of dollars in bonds, about 21 billion about, and they sold bonds at a loss of 1.8 billion dollars. Okay,
Oof.
and because of that, just to pay off some high priority clients, they're like, we need our cash to pay our employees, so they withdrew some. They had to sell some at a loss, and obviously that's not a sustainable method, right? They can't go on like this, keep making loss, keep just to give the money back. So they thought about trying to raise some more funds. They thought about trying to give away some shares to raise some funds. And they were doing this in
Mhm.
quite a hurry, in quite a panic. And panic spreads like wildfire, right? So that panic spread all across the Silicon Valley. People started to taking a look at what's happening there, and that's it. As soon as these people smell danger, it's over. Stock market reacts faster than a F1 car on a turn. And like stock prices dropped 86%. 86%.
Yeah.
That's unbelievable. That's like, your life is going in front of you. And
Yeah.
the
I,
regulators,
I
yeah,
just, yeah. Before we go to the other part, like there's this guy named Balaji Srinivasan. He said this right. The Feds lied, the banks died. Okay, and basically in 2020 when the interest rate was 0.1%. Okay, like the Feds didn't like said that it's not going to increase. They kept promising like we will not increase the interest rates in the next coming years. They estimated that in 2023 the interest rate would still be 0.1%, whereas the percentage now is
yeah.
4.75%, which is a 47x
Yeah, but
increase
dude, the thing is
as
like that's
to the
very unreasonable. To expect that the interest rates would stay at 0.1%, like that's very, very unreasonable. Because
but
like
but the Feds are the one that
they
predict
have to say that, right?
they
They
do
have
the
to say
predictions
that.
and they're the one that
No,
set it.
I understand what you're saying. Like, but the thing is, you can't take it at face
Mhm.
value. So the feds have to release certain statements in order for the general public not to panic. They're basically playing
Yeah.
this push and pull tightrope kind of game where anything that they say could lead to a recession immediately. Their words
Yeah,
have a
exactly.
large effect. So if they say that I'm going to increase the interest rates at a time where the stock market is very shaky, not stable, then that will cause the stock market to crash immediately. The economy will crash and burn. So there's no way they can make a statement
Mhm.
saying that no, we will have to raise interest rates. So whenever like you
Yeah.
can't really like take the Fed's word at face value. Their job is
Yeah.
not just, yeah.
Yeah. That's the main outrage that I'm seeing on Twitter is the fact that even during so the recession pretty much started last quarter itself, right? And in 20 the last quarter of 2022
Yeah.
basically, essentially. And the fact that the Feds were denying the inflation and they kept denying the fact that no, the recession's not real, it's fine, we're going to be okay. And then they realized some of the losses that were happening, and then they increase the inflation, I mean the interest rates to like super high. That's the main outrage that
Yeah,
economic
yeah,
solution.
that makes sense. So, firstly, obviously, they have to, like I said, they have to like deny recession at all costs. Otherwise, if you give in and be like, "Yeah, we're going into recession," people are gonna panic. More jobs are gonna be lost. And then once they denied it, people actually they're like, "Okay, fine, maybe we can still do this." People started taking a lot more bonds, like you see from banks like SVB. They started taking those bonds at a very very low interest rate because like you said, like the feds promised that they wouldn't raise the interest rates, so a lot of people are like, okay, we'll just go ahead and take these rates. Okay, there's no recession, we'll go ahead and take this money and we'll try to like create our own startups, we'll try to influx into the economy. And then at the end of the day, who gets hurt? It's the banks, right? And that's exactly what we saw.
Hmm.
So I have a very basic question.
Yeah.
Um, so w- when you say the interest rates are 0.1%, what does it mean? Like to a I mean, this is like a very institutional investor or someone who is in a financial
Mhm.
industry. They'd probably relate to it, but to a common retail investor, what does that even imply?
Yeah, that's very
That
simple.
number.
So an interest rate, just think about when you, I'll break it down for like a common person. If you like take a loan from a credit card, you're basically, or like you're using a credit card and you basically have to pay it back, right? Or let's say let's look at EMI also. If you like buy, let's say, a phone on EMI, what does that mean? You have to pay every month interest, right? So
Right.
that interest is basically your the cost of taking that money beforehand. So that money is not actually with you, right? It's someone else's money. Let's say it's the bank's money, and you're borrowing that money to get something that you want immediately. But what's the price of having access to that money? You essentially have to pay a certain percentage in order to make it worth it for the lending party. So
Right.
essentially, this interest rate is something that the borrower has to pay in order to have access to that large amount of money immediately. Because let's say you're like trying to start a company, you obviously need a lot of capital. Who can supply the capital? The bank. But you basically have to pay that bank a certain percentage in order to get access to that capital. And that percentage is dictated by the federal government most in most cases. And you can basically negotiate an interest rate with the bank itself, but there are certain guidelines that the government imposes, and you basically have to follow that.
Right. But when they say the interest rate is 0.1%, like
Yeah,
Yash was mentioning, there was
yeah,
0.1 and right now it's 4%.
Mhm.
yeah,
I pay I pay much higher interest rates
yeah,
when I take a loan. Right now I have
yeah,
a car loan myself, right?
yeah,
So but the interest rates that I'm paying is like 9%, 10%.
yeah.
So where is this 0.1% coming from?
Yeah.
As in like
So essentially, when the U.S. government also has a lot of reserves, right, which the banks have access to. So it's like think about like wholesale versus retail. So the
okay.
wholesale is basically the bank accessing the money from the feds, but paying that certain Fed locked amount, and then you are negotiating a deal from the middleman for retail prices, if that makes
Okay.
sense. So there's two parties involved. The bank is borrowing from the feds at that certain fixed percentage, which was 0.1, and then the
Mm,
bank is basically giving it to the people at a bit of more of a margin so that they make some money. So
mm,
those are the bonds. That's exactly that comes back to your question as to why are bond prices, bond returns, and interest rates inversely proportional,
mm,
because the interest rate is what you're taking from the feds, and then the bond price is what you're giving away. So if this side increases, then this side will decrease, right?
mm,
So what you talked about from your car loan was the negotiated price that you took from the bank.
mm,
Okay, so now as though the feds, so they borrowed some money from the feds at a specific amount, and they gave that money out. So now that percentage, at 0.1 percentage, everyone has access to. So whoever's borrowing from the bank, they'll know that bank guys, you got the money at this percentage, so I'll only pay you this much extra. And that's
right.
locked in. Bond prices are locked in, right? But if
Mm,
the feds start to increase, they have to pay more money back to the feds, and they can't ask for more money from the user. So they're
right.
stuck. They're stuck, and the bank has to take the hit. And that's exactly what happened.
Right. So I have another question here.
Yeah.
Um, how? how is this even being allowed? What I mean by that is, uh, the bonds are long term, right? Bonds are something that is like 5 year, 10 year
Yeah,
lock in
10 years.
periods,
Yeah,
like you're saying,
yeah,
right? And the kind of money that is going into these bonds are deposits made by highly volatile industries. Like startup ecosystem is extremely volatile. There's a company that exists today and some crash happens, or some economic impact happens, and like they're all going to go for a toss,
Hmm.
right? Like the way FTX crash happened, for example.
Hmm.
It just happened overnight. That's how volatile these markets are. So how are they allowed, how are regulators allowing these banks to use such volatile capital in such long term financial instruments?
Right. So the thing is, like, they have to do this because, like, these are the things. These startups are the ones that are building the economy at the end of the day. So the feds will recommend that you keep a certain percentage, especially for startups, because if you don't, then these startups will struggle and your country will start to fall behind. What made America America? Because of the rise of companies like Google, like Facebook, like Amazon, those really dominated on a international scale because they were able to thrive in their environment because they were supported by the government, by the banks. So because they were able to do that, that's why America was in the position that they were at. And that's why they have to make these kind of risky investments, like you said, because obviously some of them will fail, but the ones that succeed will make it worthwhile.
Yeah. And one more thing, just to tell. So right after the crash that happened in COVID, India was in a bad space, and the Feds essentially in India reduced the interest rates so that money can start flowing into like startups and everything. That's why 2020 and 2021 there were so many like outrageous like growth
Yeah,
in the startup space. Everyone's like trying to look for
yeah,
IPOs. The number of IPOs
yeah,
that happened in 2021 was just
yeah,
outrageous,
absolutely.
and that was because of the fact that India was trying to
Yeah.
recover, and the interest rates were like
Yeah, it's
super low.
less. People can take a large bulk of money, influx it back into the economy by creating something that people need. So you have to think about this entire market cycle. So the market cycle is like any normal cycle, life cycle. It has like a point where it has to go up, it has a peak, it has a point where it has to go down. And the feds have to basically control this market cycle using the interest rates. So as like the market is like approaching like its peak, they have to increase the interest rates higher and higher and higher so that the market basically continues its cycle. And as the market goes to the low, the Feds have to reduce the interest rate so that it can start to pick up again. Neither way is like too good for anyone, for it to like skyrocket or for it to go all the way down. Because if it skyrockets, everything will get too expensive and like um, the
So
government will not be making enough money. But if it gets too low, then there'll be no jobs and like it's difficult. It becomes difficult. So it's like a tough, like a tight walk kind of situation for the government. So obviously that's not easy. But
yeah,
yeah,
and when you say that, when the market goes too high, do you mean factors like inflation and like mm, economic
yeah, absolutely. Everything become
catastrophes and stuff like that?
yeah, yeah, yeah. Everything
Okay.
like plays in. Everything has its own factor: interest, like, inflation, then bond prices. Everything is like interrelated and is a part of this massive moving cycle that is our economy.
Got it.
Yeah.
And
You know what's crazy? Oh, sorry. You know what's crazy? There's an article that came out in December itself. There's this website called Seeking
Mhm.
Alpha. So yeah, one of their writers called Cashflow Hunter. Maybe this is your friend. Yeah, he like wrote an article about like how SVB's financial there's a blow up risk and all that during that, and it got a lot of backlash as well.
wow,
I I feel, and not a lot of people like believed it.
wow.
So
But
yeah,
did he have the
it's
same
crazy. And then
hypothesis, or like the same theory as to why it is going to
yeah,
blow up?
no, so it was a proper data driven research paper. So basically, he's looking at the growth of the number of
Mm.
deposits and the
Mm.
loans, and he looked at their financials
Oh,
as well. Right, they're split up as to because these are all public, right? SBB's
Okay.
things are
Yep.
like balance sheets are all
Yep.
public, so you can see where what they have. So I actually have a chart right here. Let me just show you. So this is a second. So this is the current holdings of SVB, right? Balance sheet. So this is what they owe, the debt, and the customer deposits are obviously debt as well, because you have to return the money at any given point, right?
Hmm.
The $173 billion, and this is like other loans or like whatever they
Hmm.
have. Okay, uh, this is the so they're holding $91 billion worth of securities, but they were selling. So this is what caused the panic,
Yeah.
right, Anish?
Selling at a loss.
The 26
Selling at a
billion
loss is
dollars of
always a
yeah
panic because no one would intentionally sell at a loss. No one would do that unless you really need that capital for something or you're being pressured into it. No one would ever sell for a loss.
yeah
I would think
yeah
that the $91 billion, which says hold to maturity, that is something that is the long term 10-year bonds, right? Like as in you want to hold these
To
securities till the
maturity,
time
yeah,
they
to get the
mature.
entire
Yeah,
payout for what you gave in.
yeah, yeah. And I think that.
yeah no
Hmm.
so this was part of that as well. These securities, they it was part of this. They wanted to obviously hold it to maturity because that's only when they get the true value out
Hmm.
of it. Okay, it's only when they were like, okay, we need money right now. Okay, and they panic sold. They put $26 billion of their securities for sale, and I think at a like immediate 10% cash or
So I have
something.
a question for you
I'm gonna
guys. Now that we have seen two back-to-back catastrophic events involving large corporations holding the public's money because of errors in their the way that they handle the money or the way that they're doing their books, and eventually the regulators had to step in. Is it fair to basically now have a regulating body which is continuously checking the books and making sure everything is okay with companies that are holding large sums of the public's money? Do you think like
public's
something like
money.
that is required?
Isn't
Yeah, I mean, sorry, you want to go first? What's up?
Yeah, I was going to say, isn't don't we have regulators who are already doing that, who are scrutinizing these companies? We have third-party auditing that is already happening, and it is not just for like companies that hold vast sums of public money, but any company that is being traded in the public stock market. There are these guardrails and checks and balances that are
Yeah,
in
so
place.
they're required to go through auditing either through the government's thing or through like a third party audit, like let's say Deloitte or some accounting firm like from the top four. And that's not happening very regularly, apparently, because obviously otherwise things like FTX or this SVB thing wouldn't have happened, right? So, do you think maybe they need to turn up the level of scrutiny or the level of checks that are happening, especially when your company has crossed the threshold of the amount of money that it is handling for regular people or the common folk?
Yeah, I think it's a great learning opportunity, right? I mean, like if you look at, honestly, we have to give credit to the regulators because the rate at which failures are happening and bank runs are happening have significantly decreased when you compare it to the, from post 1950 to like 2000 or maybe 2010. And from 2000, I think the last biggest crisis happened was in 2008, right? And post that we've had a
Yeah.
pretty stable fiat banking system in place, right? But then having said that, I think this is a loophole that has come out in the light, right? And such similar loopholes, I mean loopholes with similar characteristics have to, can be scrutinized, and they can try to bridge those gaps, right? So this is a good opportunity for regulators to prevent a similar occurrence from happening,
Yeah,
right?
because it's not just Sam Bankman-Fried, or it's not just this the bank. It's also like Adani that has tried to like get away with something. I'm sure there's so many other companies that are like really sweating right now because they're like, okay, the dominoes are falling one by one. My books are not that solid. I hope this doesn't happen to me. But at the end of the day, they're in charge of money that's going to like small families, and that's paying off the salaries of God knows how many startup workers, and you know,
Right.
more negligence here could just cause a whole economic collapse, and that's not what we want, right? We want like, yeah,
And yeah. So, so obviously the public sentiment is very, very important here because now everyone's just like, why should we even trust
yeah,
any
exactly,
bank, any regional
exactly,
bank? Okay, we should essentially trust a top four bank or something like that, which is JP Morgan or Goldman Sachs or like one of those. But as 2008 has shown anything, even a top four bank was in big fire that time, and the government had to bail them
Yeah.
out. Okay, and unfortunately, Lehman couldn't be bailed out. Okay,
Dude, I just wanna.
so now,
yeah,
Uh,
yeah, I just want to finish my
yeah.
thought. The thing is, there needs to be a new system in place, which is meant to instead help the banks. Instead of that, it should be for the customers as well. Okay, look, when you deposit a bank, literally 90% of the money is pretty much gone. They're not keeping
yeah.
it, they're investing it. Okay, and a lot of people are used to like, okay, like even if they have like money in the bank, it's growing. Okay, they give you that 4%, 5%, or how much is it
Yeah,
nowadays?
it's
I
six
can't
point
remember,
five
but back in the
percent
day it was
for
crazy.
1 year lock-in period for an FD.
1 year lock-in period for FD, or even
Yeah,
without
it's
FD,
three
you still
percent.
get some interest
Mm.
also, right? 3%. Okay, and see, first of all, like that's why you need a new system in place because 3% is not beating inflation
Yeah,
by a long shot. Okay, okay, and for some people who just want to keep their money goddamn safe, okay, there just needs to be a bank where they don't give you that interest rate. It's just yours. It's your like wallet essentially, like how it works in crypto where it's non-custodial. Okay, only you have access to that money. Nobody can pull that
mm.
money
And you
away
can
for
decide whether
investment
to
or
give it
whatever.
away as a bond or give it as an investment. That's
Yes,
exactly what my
exactly.
app idea was. So when we
Oh yeah,
discussed
yeah.
about that, so let's just like keep that for another day. But yeah,
Huh.
essentially that's what it was. But okay,
Yeah, that's a
so
good idea.
coming back to this, so coming back to this, let's just talk about a little bit about the emotions. Okay, because I feel this has an effect on the Indian market, and that's what's annoying me a lot right now. Because we are obviously trying to decouple from America, and we're trying to emerge as the leading economy in the world, or at least in the top three, right? And for this to take place, and for our Indian Bank Nifty to drop by like 700 points when we're on a recovery run, that just annoys me. Because like what does this like I understand, okay, so let me just give you a brief about the impact in Indian startups. So SVB had launched a Indian finance unit in Bangalore and in Mumbai, and essentially they had been starting to invest in startups like Paytm, InMobi, Bluestone, and Shadi.com, Yash's favorite, from like 2003. Okay, so the thing is, I understand that they have some investments in India, but what's the reason to like short Indian banks because of this? Like they have not proved that Indian banks are making the same mistakes that this SVB bank is. So I don't know. That just kind of gets me riled up.
Or whether the Indian feds are fucking around like the American feds were. Right. There's no proof of
I
that.
mean, I wouldn't say the American feds were, like you say, fucking around, because, like I said, like I
Uh,
have to defend them because it's not a easy task to, like I said, walk that tightrope and manage inflation, deflation, and assure the people as well. Like they're in charge of the people's sentiment, and they have to make sure that the people don't panic sell or take their money out of the economy. So they have to like kind of assure the people that no, we're not heading towards a recession or anything. So I don't really blame the feds in that sense. It's just about how the banks manage their money. If they're really experts, they would have predicted that, even though the feds are saying no, we'll keep it at 0.1, they should have predicted like no, as usual, they're doing this to keep market sentiment under control, but they will have to eventually raise the rates in order to maintain that economic cycle that has always been there. So any experienced
I,
person would
I mean,
have
okay.
understood that balance.
Yeah.
Hmm. So I don't think you can see this, Anish, right now because you're on
Yeah,
your
I
phone.
can't.
But I'm just sharing my screen, and yeah, basically there's a graph, okay, and it's showing the unrealized gain and losses of investment securities, okay, throughout there's a timeline from 2008 to 2022. From 2021, okay, there is a drastic. So let me give you the average, okay, from 2008 to 2020. There were only, I would say, half of the years where they were in a loss, okay, and a loss of minus 75 billion dollars, okay, versus around 2021, mid 2021. Just to give you a context, the the lowest loss was minus 300 billion dollars, and then after that the losses have just been increasing, okay. So these unrealized losses of the securities was there from 2021, right? So the the feds definitely saw it coming. The feds, like, that's why the biggest outrage is there, because like all this is public, okay, and that's what I've been absorbing, this side of it, okay. And it's not like the feds are to blame, but they could have handled this better instead of panically increasing it by like increasing the interest rate by 47%, 47x, essentially. That's
Yeah,
my only
I know,
like
I
two
agree. It's
cents.
just, all economies run on a loss. To be fair, like almost every single big country almost has like $1 trillion in debt. And America is the leader of that,
Yes, yeah.
but it's just how it is. Like that's just how it's been. And they do that so that the money circulates in the economy instead of with the government.
Right.
So what do you guys feel about this? There's a few hard hitting points. Second biggest bank collapse in history. You know, um, it's also affecting the Indian market. So what do you guys feel? Like, how do you guys feel about this?
I honestly think that it's a big uh, gap that they were investing in long-term securities with volatile money. That should be something that government should have, or regulators should have caught it beforehand, or they should at least bring in some kind of guy, you know, g-
Yeah, someone to like
regulations
some expert
around.
to help them like decide what to do, because at such a
Yeah.
large level you're and being invested in about 50% of 50% of startups in America. You know what that means? Like you're basically in charge of paying out so many people in America. Like if you are not able to give them the funds back, then what are they going to do? Like they all have
Yeah.
home loans to pay off, they all have families, they all have like lives to lead. So if you can't pay them, then it's gonna be a meltdown. It's gonna be catastrophic.
Yeah. Yeah. So do you know what's crazy? That the banks obviously have a 250 k. The
Insurance.
government will bail you out, basically. Yeah. So if you have like 250k in the bank, they'll bail you out. And do you know Giannis
Yeah, of course.
Antetokounmpo,
Yeah, it's
the
Vatsa's
basketball
favorite
player?
player after
Of
LeBron.
course.
I think
Yeah.
so.
Is it?
Yeah, it's good.
Okay. So this guy was super smart. So when he made like a shit ton of money, he opened 50 banks and he put 250k in every bank.
Wow.
Nice,
Okay, because he's already been through that in like Greece or
nice.
something.
Yeah, I feel like I would do that as
Okay,
well.
that he doesn't trust it. It's mad. So another thing that I was concerned about is so a lot of companies in India are registered in the US, okay, because they're part of these accelerator programs like
Hmm.
YC. YC's primary bank was Silicon Valley Bank,
Oh,
Techstars as well, and all this stuff. So there's a lot of Indian startup money that's been entangled in this as well. Um, and that's going to be crazy. I'm not even sure whether my company is there. I'm very very sure that we have an American account
have
only. So I hope
They
it
would
goes
have
they
probably
US.
must
told
have
you by
been.
now.
Saturday, Sunday, they don't tell shit. But anyways,
Most
we'll
people
see.
would be
Have you
lucky,
heard
like
of?
consider that a lucky
Okay.
thing.
Yeah, but yeah, so this money is just frozen, and it's going to be crazy of how people are going to
You were watching that emergency
these people.
podcast on YouTube, remember, Yash, about that guy from All In
Yeah,
podcast, and he was advising
yeah,
some of the people who had their companies affiliated to this bank, and he was like, first thing that you have to do, stop paying any kind of bills that are given to you. You just tell people that, no, I have my money tied in with this SVB financial crisis, and I cannot pay out any bills right now. So this is Biden's first thing:
Yeah.
stop paying all bills. That was
Yeah,
hilarious.
I would say stop paying the corporates, but
That was
rather
really
pay the
funny. Yeah,
people.
I agree with
Right.
that. But for someone to say
Yeah.
it so bluntly, like I like that. That stuck with
Was that
me.
after the crash or before the crash?
Yeah, just after the crash, we were watching the emergency
Just after
podcast
the crash.
yesterday, last night, or something.
Oh,
Yeah, it was live. It was crazy.
nice. So, do you know any Indian startups that are impacted because of this
Yeah, so
in
like
the
I
Indian
said,
economy?
SVB had invested in Paytm, Shadi.com, Bluestone, and Mobi, but those are not exactly like startups. I would say they have a lot of money, of course. So I don't know about any fresh startups that are completely affected by this.
Yeah, we can probably check on Crunchbase, but your I don't know actually. The see investment is totally fine, right? Because they've already sent the money. I
No,
suppose.
but the thing is, they hold the money for the startups. That's the
Oh, they
biggest
hold the
thing.
money in
They
the
had
startups.
so much assets of all of these startups in America, and they're not able to like. So then that's where the issue started from, Yash. Basically, when these startups try to take their money back because they're not able to get funding from investors, angels, and they're not able to do IPOs, they try to take the money back from SVB, and that's exactly where the problem began because they had to pay off these like quick withdrawals. They had to sell their bonds at a loss to get that to raise that capital, and then they're running out of money. Obviously, they can't keep taking losses, and that's where they had to try to raise funds at a panic, and that panic spread and essentially led to an 86%
Yeah.
crash, which no one could take, obviously, and so the regulators had to seize the bank. They had to just seize it.
Okay, I have one
Yeah.
more question. In when it comes to investment and especially institutional investments, they always say these government bonds are the safest, right?
They do say
Right?
that,
Like
yeah.
it's always been
Yeah.
told to us.
They do say that, yeah.
Oh
Yeah.
man.
So, okay.
Jesus.
So, you know why it's safe for us? Essentially, like I was saying, the hit is taken by the bank. So, it was safe for us, essentially. And
Mm,
especially if you can get that bond rate at a very low price, like what people did at
yeah.
near that zero point 0.1, anyone who took like $1 billion out essentially gets to keep that billion clean and use it to like make a shit ton of profits. So essentially, it is safe for the people, but for the bank, it becomes a bit risky if there is, like Vatsa said, a lot of volatility. It's a very volatile market where the inflation could go up or down. It is a bit of a risk, so you have to manage that risk properly.
I have one question. Okay,
Yeah.
Right.
so why did these companies, these startups, all of a sudden start doing withdrawals? Like, what triggered their this massive bank run
Yeah,
that they're
yeah.
doing?
So we are going through a somewhat of a funding winter. So even funding has its own cycle. At certain points, there'll be a people funding for anything, left and right. You're just giving out money. There's like a hot topic, like if you're in AI or if you're in like some, before it was fintech. If you're in any of these, like you have a very high probability of getting money from a VC or an angel. But if you reach a funding winter, as they call it, because some of their hot investments didn't work out, then it's very difficult to raise that money again, or very difficult to get any sort of money, especially when IPOs are also not working. Most IPOs that are coming out are crashing fully. So there's no other way to get that money in order to pay your employees. So you have to take the money that you have in the bank. There's no other option, right? So when you receive a large amount of money from a VC, let's say $1 million round you have raised, you won't need that entire million immediately, right? You'll need, let's say, maybe 50,000 for the first month, 50,000 for the second month. So maybe you'll keep around 100, 200K with you. You'll keep the rest of it in a certain bank, a bank that you've trusted for over 40 years, like SVB. You keep it in that bank because they guarantee you that they will raise that money by a certain percentage. So obviously, SVB must be having some sort of startup program where they give out a better return for startups because obviously they have their hand in over 50% of American startups. But once that bank fails, and once you start to like try to take that money and the bank fails, that's where all the problems happen. So to answer your question, is because we are going through a funding winter all across the
Right.
world, and that's why
Yeah.
they
Right.
had to
To
withdraw.
put it in a to put it
Man.
in a nutshell, there was an investor. Sorry, there was a funding winter
Yeah,
season that happened
yeah,
because of which startups had to go and withdraw all the deposits that they did
yes,
in SVB,
yes,
and that coupled with rising interest rates led to the
yes,
bond value falling, because of
yes.
which the assets of
SVB,
SVB
yes,
basically plummeted, and
yes,
hence they couldn't repay these banks that were these startups that were
yeah.
asking for their own money,
Yeah, and they
right?
had to
And then
sell
they
their
had to.
bonds at a loss in order to pay off some of their high priority clients. And obviously, that's not a very sustainable thing. So
Hmm,
then they had to try to raise funds during this
hmm,
winter that no one is able to get funds from. But they had to try to
hmm,
raise funds, which spread that panic. So these guys, these investors can smell that panic out of, like, miles away,
Yeah.
from miles away. Their network will just let them know, like, okay, SVB is trying to raise. They'll go check their, like, bond transactions and done. They're like, oh, they're selling at a loss. They're trying to raise money. They're fucked. Something is wrong. It's clear red flags,
Yeah.
right? They start to sell. Other people will start to pick up on it. Other investors start to pick up on it. 86% crash. It's done.
Mhm.
It's done. Feds had to intervene, and that's it. That's where we are at
Yeah.
now.
And dude, what's crazy is the number of the deposits are 173 billion dollars. Okay, and SVB. So I'm sharing my
Yeah,
screen. Let me put it
175
in the
billion. Yeah.
audience. Okay, yeah, 175 billion, and the amount of cash that SVB had was only 14 billion in cash. Okay, so even if 25% of the customers were trying to pull their funds, that itself is around like 40 to 50
Yeah.
billion dollars,
Yeah.
which SVB did
Yeah.
not have. And
wow.
when they noticed that, that's like, if you look at it mathematically, that's why they were selling
Yeah.
that number of
Yeah, about 21
securities
billion
as
they
well.
sold at a 1.8 billion dollar loss.
Yeah,
1.8 billion
so
dollars
see,
loss is no joke, honestly. Like,
usually
yeah,
usually these all these banks and all these companies, they have their own team that kind of tells them where
yeah,
to how to invest their money
yeah,
and where
correct.
to
Yeah,
like as a strategy, right? So, and
yeah,
they will obviously have like certain risky asset
yeah,
classes and certain moderate
yeah,
risk asset classes.
yeah,
This is such a big red flag right away.
yeah,
I mean, like post
yeah.
game, when we're doing post game,
Yeah,
it's just like
analysis. It's just
right
like,
there.
how did you miss this? Like, how could you miss
Right.
this? Such a big red flag. But that's exactly it. Like, that's exactly where my first question came from. Like, do you think we need to tighten these regulators or have some sort of team in place which keeps them in check on a more regular basis? Because we saw this happening, like, with FTX. We saw this happening with SVB. We saw this happening
Mhm.
with Adani, even though Adani has the funds to cover it. The thing is, like, at
See,
some point, the system was being abused, is what I would say, and that's not great, especially for the general public or the people who have the money tied in with these guys. So
But but
yeah.
honestly, I think that SVB is a little bit in a different class altogether. Like the case of SVB belongs to a separate category as opposed to FTX and Adani, which are straight up, we have to use the F word, like the fraud word for them, right? But then the
No, but
case with
dude,
SVB
the
was.
thing is with SVB, it is sort of like fraud. Like, why would you invest so much of your assets at such a risky area? It's because you are trying to get more profits. Essentially, it's not exactly fraud, like you said, but it's almost like fraud where you're trying to abuse the system and try to make out with as much profits as you can in such a risky environment where people are relying on you to be safe.
I think it's a screw up more than a fraud. It's a
Yeah, it is a
they did
screw
not.
up technically.
Yeah.
So what do you think the solution should be? Should it be like a rule that at all times you should have 50% of your deposits as a bank?
So
Could we, like, if a rule
So
like that
according to
comes?
me, no, that's a bit tough because in certain emergency situations, you may be required to obviously give out for certain use cases. For me, what
Yeah.
I think is essential is on a weekly or maybe bi-weekly or even monthly basis, I feel any company that is handling public money after a certain extent, let's say above $1 billion, has to disclose that information or has to disclose their financial statements, their investments, and everything, their book essentially, to a third party analyst appointed by the government, which is completely separate from the government and from the company. And regular reports need to be done on that.
I
Like
mean,
they need to get a score.
we have a bunch of these companies, like Yash was telling earlier that there was what is that, first alphas, or
No,
whatever the term
those
name
guys are
was.
just reporting. Like they give out like news articles.
Reporters.
They do
Yeah, but there
reporting.
are
Yeah,
people calling it out. There are people who are even Adani was called out long, long ago
yeah,
before
dude.
Indian
But the
consumer
thing is,
came
we
out.
can't like see what's happening behind the scenes of SVB. No one has the authority to go into their books and see because they're a private firm. No one has the authority other than the board to go in, check their books, and see exactly where the money is being spent or where the money is. No one has that authority. I feel the
So I have a
government.
question.
Yeah,
Yeah.
If a company is a publicly listed, publicly traded company, aren't they supposed to disclose their books every financial year?
Every quarter. Every quarter.
yeah,
It's
yeah.
audited.
I'm not sure if they have to disclose every single thing or if they can just give out a summary. So
Hmm.
there is basically some sort of
Yeah, yeah,
contingency there to work in favor of the company, of course.
Hmm.
yeah. And these accountants find a way to make it all pretty.
Yeah, absolutely. Like they bury it.
Yeah.
They bury it under so much information. Like you just don't know what you're looking for. That's why it has to be like handled by a
Yeah.
very
Exactly.
professional company like maybe KPMG,
Uh,
BCG, one of those.
Or maybe we need an AI
hmm.
to like
Absolutely. We absolutely do need an
basically,
AI to keep everyone in check. Yeah. I agree with that
yeah.
solution. That could be
Yeah.
ideal.
Yeah. So this is some crazy shit I'm seeing on Twitter. Few things that I want to mention. Okay, one, there are videos of people in America, or like everyone's taking their money out regardless. So that regional banking thing is definitely going to become an issue. And all those redneck Americans are totally correct. I don't trust the bank. It's okay. It's becoming a reality. Okay, and then there's obviously the few rumors that the way SBB can uh, come back is like they're going to be acquired basically, essentially. Okay, and also like the stock is dirt cheap, so they're like
Yeah,
uh
that's
Ben
what the
Elon.
regulator will try to do now.
I mean,
So they have control over it, but essentially they don't want to. They can't handle it, so they'll probably try to give it off to a larger banking firm and allow them to acquire it at a special rate.
yeah.
Elon did say he'll buy though,
So
right?
so that's what. So no, no, not Elon. I don't know what Elon has said about this, but there are a lot of people saying that Twitter should buy SVB
Twitter,
and
bro,
become a
Twitter
decent
is
bank.
burning money at like such a exponential rate. He's literally setting money on fire every single day. Like it's, I don't think Twitter needs to have anything to do with this right now.
Yeah, not right now. Maybe if it was different times, if Twitter was itself
Yeah.
stable, then this. Because I mean, that's what Twitter wants to do, right? They want to become a super app like
Yeah,
WeChat and have like basically become a bank.
yeah.
It'll be
Also,
crazy.
there was this news. I don't know if you guys heard that a few days before this crash happened, the CEOs and the CXOs of SVB dumped the shares and they made like mad money.
Yeah.
Like that is so not cool, dude.
Yeah, that's
I
not
don't
cool.
wish.
Exactly. Exactly. The government should go seize that cash, give it out to the people that have their money invested with them.
Yeah, yeah. They should definitely. These guys should be held totally accountable, dude.
Dude, that's
Like,
crazy, bro. Imagine
So,
like it's like your ship, like you built up this ship over 40 years with so much trust from all the people in the Silicon Valley, and it's like this ship filled with gold, and like the ship is sinking, and instead of like trying to fix it or trying to be clean or you know, you take as much gold as you can and you like escape in your private helicopter.
yeah,
Like
yeah.
what the
Like in a
hell?
chopper,
That's
you
not
just
cool.
escape.
That's not
man.
cool.
Okay, so let's do predictions, huh? Like how we think what's gonna happen. Okay, so obviously there's my like because I work in Web3 and like I'm super optimistic and pumped. Okay, so we have seen the ups and downs of crypto. Okay, we have seen
Bitcoin is at
decentralized
18,000 or what now?
money
18 or
taken away.
19K, I think.
Yeah, around that much. I know. I think it crossed
It came
20 and
back
it came
down to
back down or
19.
something. Yeah, crazy. So
16,000.
It's at 16K
we have
now.
seen obviously FTX go
Oh no,
down.
sorry, my bad. INR. I was looking at INR. One sec.
Hey,
16 means it's around
it's
20
no,
then. 8 into, right? So it's
20K.
around 20.
Yeah, 20K.
yeah. So um, we have seen the decentralized exchanges fuck up. Okay, now we have seen a centralized
Yeah. So
bank
which
fuck
was the
up.
worst fuck up?
Okay, which is
You
the
had to
worst
choose the
fuck
lesser
up.
of the demons.
Okay. Yeah, and this is where I feel the web 2 and the web 3 would come for that marriage and bring that balance in, where your non-custodial wallets, where no one has control over the money that you have. That money is yours, and it's always there, it's untouchable, versus your other money, which will get that interest rate that is needed, which will operate like a bank, essentially. There's one of the most famous crypto projects. It's called Bankless, and their whole thing was how we need to have non-custodial wallets for the people, and if you want to invest your money, if you want to do this, there will be options for you, and that money will be in a separate wallet. Okay,
So,
so I'm very interested in
Yash,
this, and
I know you
hopefully
love Web3
there's
and
more.
I'm all in for a decentralized bank. It's just that what worries me is the technology. So every day a new technology, or like every time a new technology comes out, it makes the other one sort of obsolete.
Mhm.
So let's say you go in with a bank,
Yeah.
uh, which is on the Ethereum network right now, and you have your money invested with them. The thing is, if they crash, then that becomes very risky for you. And they will crash if another superior technology comes out. So I'm all in for it, but only once I feel that the technology has reached the level where, it's stable and nothing else can really come out and displace it.
True, and as we have all noticed, like right now in Web 3, there's not a lot of application going on. It's more of the
Yeah,
layers. It's the infrastructure that's
yeah.
been laid out. Okay, and actually, wait, let me just so um, Coinbase basically created a new layer two. Okay, so basically, a lot of layer ones were
Hmm.
being built. Okay, that's your new separate
Yeah,
blockchain
correct.
as well. Okay, um, so if you go to at base, give me a second. Yeah, array. Okay, it's Coinbase only. So yeah, so Coinbase came out and built a layer two on top of I think the
Yeah.
Ethereum.
Has to be Ethereum only there.
Yeah, on top of Ethereum. So what will happen is now a lot more people have more faith in
Yeah,
the
of
Ethereum
course.
technology and the
Yeah.
ecosystem, right? Okay, so what's going to happen? So that's what. So we are not building Web 3 right now for the next 5 years.
Oh, and
We're
one
building for
more
the
thing you
next
have to
10
think
years.
about is if you're actually using currency on the decentralized web, you will have to basically buy cryptocurrency. You'll have to use cryptocurrency. So it has to be either Ethereum, Bitcoin, or you can go with USD Theta. So that
Hmm.
again is like one more thing.
Yeah.
Hmm.
Yeah, so it's a it'll be all about the tokens and all that stuff. So imagine, so one is your USD Tether, which doesn't
Yeah,
fluctuate,
it's linked to the
right?
USD.
It's the stable coin. There are many other stable coins as well. Okay, so that could be saved as your non-interest, non-custodial wallets, where that money is all yours. The second you want it, you get it. Okay, nobody's touching that money. Okay, and then the others could be as like investment coins or like whatever. um See, I didn't say crypto, I'm just saying that the blockchain can be
Yeah, but you can't really use fiat
an
currencies
outlet.
on the blockchain. It has to be cryptocurrencies.
It has to be
Okay.
crypto, yeah,
Anyways, I
it
think we're
has to
staying
be
off
based on
topic.
blockchain.
That's fine. We can save the crypto Web3 talk for another podcast. I guess we've talked about all we needed to for SVB, and what's left is just to see what happens with it.
Yeah, we
Yeah.
have
So
we
cool.
have
Yep.
It was fun. Fun talking with you guys.
Hmm.
We'll catch up. We'll catch up later.
Yeah. No, so no, all I was saying is like
Okay.
this is what's gonna like this is what people are gonna work
Yeah.
on, and as you said, like about the superior technologies. I think in the next 5 years, the layers and will be
Hmm.
solidified essentially, and then these applications will be built out on. Okay, like
Yeah.
Have
yeah.
you guys heard about Sam Altman starting this new company? It's called Worldcoin.
No.
Oh,
Yeah,
Worldcoin.
so it's going to be a single global currency that's going to apply across
Mm,
country boundaries.
Hmm.
And basically, you would have to like register yourself as a human. You can't
Hmm.
be a bot, you can't be anything else.
Hmm.
And that world coin is you can do any kind of transaction across, uh, of course, boundaries, and you can get whatever you want. And
Isn't that
that's
essentially
going to be
what
the next big thing.
cryptocurrency is? I mean, I can use
Yeah, but
Ethereum in the same way across the entire world.
Right, but Ethereum has a lot of gas fees, and it requires infrastructure to maintain, and
Yeah,
it
but
has its own
yeah.
challenges when you come to scale
so
it.
the Worldcoin
But
won't need any gas fees?
no, there is some other principle that Sam Altman is coming up with.
Okay.
I don't know a lot of details about it, but I've just read some article that
Yeah.
this is a new thing that's coming up. It's called Worldcoin. Check it out.
That's interesting. I'll definitely check it out. That's
Also, like
exactly what I
the
mean, Yash. So if I was all in for Web3 right now with Ethereum, and let's say the world coin comes out, and it's a revolutionary concept which doesn't require any gas fees. So obviously everyone's going to shift to that. Then my Ethereum becomes useless. So until and unless there's a prominent
uh,
leader, I can't
no,
really like.
no. I'm just saying this is the right opportunity for the marriage of Web 2
Hmm.
and Web 3 worlds. Okay, where there has to be enough jurisdiction and control by the government, where the people don't take away the money, and enough freedom for the people to do whatever the fuck they want to do with the money. Okay, so as you said, like the world coin won't have any gas fee or anything like that. So there are already workarounds that people do nowadays as well. Okay, so say like you're a company and you're paying your employees, okay, a monthly salary, so you can create a smart contract saying that every first of the month pay this much um, equivalent USD in Ethereum to this
Yeah.
person. Okay, so that could be coded, that's done, and you're paying one gas fee. Okay, then there's this thing called stream. uh it's by Superfluid. It's kind of cool. We'll try and like end this real fast. Okay, so I'll just tell you. So money is sent every second.
Mm,
Okay, every second it's sent. It's like a stream. So basically you just say, okay, this person needs to have uh, X amount of dollars at the end of the year. So every second that money is just being
mm,
transferred, and there's no gas fee on that.
mm.
So this can be, there's like a lot of applications to this. It could be used as a rewards thing for like the amount of time you're spending on a app or something, and you're getting rewarded for that time, and like many other
Yeah.
things. But yeah, so
Also,
let's see. I'm excited about the technology that's coming out, but it will definitely have a banking play, and Web3 will have a big like hand in how the banks are going to
yeah.
operate. This motherfucker left.
Dude, I just want to say one more thing, right? I think that
uh,
uh, like the current banking system is definitely going to dilute. It's not
mm,
going to remain as it was. Like I think banking was basically the same for the last maybe 100 years or ever since banks existed, and
yeah.
there was no other serious competitor to the current fiat system that we had. But at this juncture, with like so much of technology in our arsenal, I think that it could be Web3, it could be Worldcoin, it could be some other new novel innovative form of currency, but one way or the other that's going to take over the current banking system and like
Mm,
the current way in which things work, right? I think that's seriously
mm,
a possibility.
yeah.
Maybe in our
Yeah,
lifetime, definitely in
absolutely.
our lifetime, I think we're going to see
It definitely
some
gonna
shade of
happen.
this.
Yeah.